Good morning, everyone, and welcome to this webinar on Net Zero Asset Manager Initiative. What do you need to get there and why? Organized by the Asset Management Association of Switzerland. My name is Aurélia Fay. I am responsible for sustainability here at AMAS, and I would like to welcome Adrian Schatzman for opening remarks.
Thank you, Aurélia, and good morning, everybody. Welcome to this webinar on the Net Zero Asset Management Initiative. And within the Asset Management Association, sustainability is a big topic. But within that topic of sustainability, climate financing and the efforts to combat climate change are our single most important priority. And if we make this our priority, we also want to encourage the industry, our members, to take actions towards net zero. And if you lift that aspiration, there's no point around setting targets, setting goals, quantitative goals, and being measured against those goals on the way there. And this is why I believe the Net Zero Asset Management Initiative can play such an important role. I'm very grateful to welcome Danielle Boyd here. She's a senior program manager at the Institutional Investors Group on climate change. She will give us insights change and for the asset management industry to play a key role in it is something that is shared by the Swiss government. We're very grateful for that support, and equally I'm grateful to have Caroline Wehrle here with us from the State Secretary for International Finance. She will give us the perspective of the Swiss government on this topic. Now, joining an initiative is one thing. It needs a bit of paperwork, internal discussions, some signatures, but only once you have joined, the real work starts. What does it really mean if you're a member of the Net Zero Asset Management Initiatives? And I'm extremely happy that we can provide a fractional perspective. It's not one perspective, but three. We have Hamid Amoura here, the Head of Responsible Investments at Mirabeau. We have Sascha Tijar and Benjamin Granicher from Safra Sanasin here, and Ruben Feldman from the Zürcher Kantonalbank. They will all give us their perspective on how they implement, how they live the Net Zero Asset Management Initiative in their daily lives. We hope if we can approach this topic from three different angles, that we can combine, we can deliver a package which will help, which will facilitate, which may encourage you to take a step towards a membership in the Net Zero Asset Management Initiative. With that, let me thank all the speakers today, and I look very much forward for the next hour. Back to you, Aurélia.
Thank you very much, Adrian. So we're starting the first part of this webinar with an informative part. And I would like to welcome Danielle Boyd. So she's a senior program manager at the Institutional Investor Group on climate change, to let us know what does that mean, what does net zero mean for an asset manager.
Hi everyone, just testing that you can hear me, Aurélia. Yes, perfect. Great, well thank you so much for inviting me, and it's really great. The Asset Manager Association of Switzerland is one of our first supporter organisations of the Net Zero Asset Managers, so it's great to be invited to sessions like this, to be able to speak to your members as well as the other great panellists and hear from both on the government side and asset managers implementing their commitments. Thanks for the introduction, Aurélia. My name is Danielle Boyd. I am a senior programme within IIGCC, and IIGCC is currently the chair of the Net Zero Asset Managers Initiative. So I'm really kind of speaking on behalf of the Net Zero Asset Managers Initiative at the moment, but sit within IIGCC. For those that don't know or are not familiar with IIGCC, I'm sure many of you are, and I'm sure we have some of our members in the room as well. But we have the Institutional Investors Group on climate change. So we're an investor-led membership body, and we have around 350 members, both asset owners and asset managers, as well as some data providers, data vendors, and investment consultants within our membership. primarily in Europe, but increasingly also members from the US and Australia as well. And our mission is to support and enable the investment community, so that's you guys, to drive real progress towards a net zero and resilient future. And one of the key things and most relevant things that we've done in the last couple of years is firstly establish our Paris-aligned investment initiative in 2019, which is the way that we support our members develop net zero strategies, and we come up with methodologies and tools to do that with our members. And in 2020, we established or helped establish the Net Zero Asset Managers Initiative, which I'm going to be running through today. So if we move to the next slide, just checking you can see that. For those that don't really know much about Net Zero Asset Managers Initiative, the purpose of this initiative was really to provide a global common standard for asset managers to commit to net zero and also demonstrate kind of action in line with the global goal to achieve net zero emissions by 2050 or sooner. And we have seen a kind of unprecedented amount of progress over the last 12 to 16 months. We now have 236 asset managers that have made the commitment, representing 57 trillion in AUM, and that's over half of global AUM, which essentially will be committed to net zero by 2050 or sooner. And I thought I might provide a little bit of an anecdote around the kind of momentum and growth and kind of willingness of investors to kind of contribute to this global goal in the last 12 months. So around 3 years ago in 2019, IIGC started our Paris-aligned investment initiative, which was, as I mentioned, our kind of member initiative to develop methodologies, including our net zero investment framework, and really to support implementation of those commitments. So it actually started in 2019 with a really small group of asset owners coming to IIGC and asking us to start thinking about what it means for investors to kind of contribute to the goals of the Paris Agreement. So these questions hadn't really been asked or addressed three years ago. So how can investors contribute to decarbonisation? What levers do they have? How do they ensure that they're contributing to real world emissions reductions? So these are questions that a small group of asset owners kind of tasked us with in 2019. And we started with a few working groups of around 40 IGC members. And now in April 2022, I think we have even more working groups and around 150 members, IGC members, asset owners and asset managers actively participating in those working groups to support developing methodologies and recommendations across different asset classes, and also kind of to work together to help each other implement their commitments. So and crucially, kind of the next stage of this process was to develop this commitment statement or commitment statements for both asset owners and asset managers, and hence the Net Zero Asset Managers was born, because it is the kind of vehicle that asset managers make net zero commitments through. So where are we now? So Net Zero Asset Managers is coordinated by 6 investor networks globally. So we have AIGCC in Asia, CDP series in North America, IGCC in Australasia, IIGCC in Europe, and PRI, who operate globally as well. And we're really responsible for kind of day-to-day management, disclosure processes, communication to the kind of external stakeholders around the success and progress of asset managers within the initiative, kind of reporting requirements, and of course, and most importantly, supporting investors, asset managers implement their commitments. We also have an advisory group of 6 asset managers, and the role of the advisory group is really to advise the networks, particularly around ensuring the credibility of the initiative, around ensuring adequate ambition of asset managers over time, and they will advise on any kind of changes or updates to the commitment and the initiative as required. And the Enzyme has biannual meetings, so we meet twice a year, signatories meet twice a year, often to kind of provide an update on progress and also share good practice. So if we go to the next slide, NZAM and the 10-point commitment statement that I will run through shortly is accredited by Race to Zero. So I'm sure many of you heard of Race to Zero. It's the UN campaign bringing non-state actors together to contribute to the global net zero goal. And we are also one of the financial sector initiatives that are a part of GFANZ, which is the Glasgow Finance Alliance for Net Zero. And GFANZ is the kind of umbrella umbrella kind of initiative bringing different financial sector actors together to share best practice and collaborate. You might have heard GFANZ appear at COP26 in November last year. And it's, I think, pretty fair to say that I think a lot of the early progress made by investors, by asset managers and asset owners are really kind of supporting other parts of the financial sector to increase ambition and action. So any asset manager joining the Net Zero Asset Managers kind of automatically become a part of Race to Zero and GFANZ, but the obligations on signatories are very much come from Net Zero Asset Managers itself, not from GFANZ or Race to Zero, and we're kind of accountable to Net Zero Asset Managers, and kind of membership of these two don't kind of impact the nature of the commitment. So probably most helpful, what is it exactly that asset managers are committing to? So the 10-point commitment statement that I'm about to run through draws on the Race to Zero criteria that I just mentioned, as well as kind of being drawn from some of the earlier work that IIGCC did during the development of our net zero investment framework. And as I mentioned kind of earlier, in December, IIGCC worked with a kind of small group of investors to develop this 10-point commitment statement. So it was very much developed with and by for asset managers. And we have a, one second, just need to click. So asset managers are obviously required to commit to this kind of long-term goal to reduce portfolio emissions by to net zero by 2050 or sooner. We recognise that the kind of ability of asset managers to invest in line with net zero really largely depends on the client's mandate. So a key part of this commitment is really to work with clients to gain the mandates that allow you then to manage your assets in line with net zero. So with this in mind, that one of the first things that asset managers are required to do is to declare the proportion of their AUM that will be managed in line with net zero, with the expectation that this will increase over time to 200% by 2050 or sooner, as you kind of increasingly gain those client mandates, and as you also play that role in educating and providing relevant kind of analysis and services to clients that allow you to increase that proportion of AUM that will be managed in line with net zero. And for that AUM that will be managed in line with net zero, you're required to set interim targets for 2030 or sooner, recognising that waiting until 2050 will not be sufficient. We will by far blow our carbon budget if all action is delayed or backloaded in the later years. And these targets need to be consistent with what we call a fair share of the 50% global emissions reductions identified by the IPCC's 1.5 degree scenario. And we saw this week by the release of the new IPCC report that more urgent action in these early years by up until 2025 is crucial. And the other really key element of the commitment statement is that investors are committed to prioritising emissions reductions in the real economy. So those are in the sectors and assets in which we actually invest. So we want to make sure, and we think we do this by the methodologies that we recommend that investors use, that asset managers are not just greening their portfolio, not just decarbonising their portfolio, selling high emitting assets and buying assets that are already low carbon, for example. So you really have to prioritise emissions reductions in the real economy, and the ways that methodologies that investors can follow that really aim to ensure that this is what's achieved. Asset managers must also account for the scope 1 and 2 emissions, but also material scope 3 emissions where possible, recognising that at the moment there are some kind of data challenges around this, and also methodological challenges. There are also restrictions on the kind of use of offsetting to achieve these goals, so only long-term carbon removal where there are no kind of technologically or financially viable alternatives to decarbonisation exist. And so IGC currently has some work underway to kind of support investors in these 2 elements, so providing further guidance on scope 3 emissions materiality across different sectors, and also best practice measurements, as well as additional guidance on the use of offsetting. So watch this space for that additional guidance. And so yeah, so asset managers are also required to kind of review their targets at least every 5 years. And as I mentioned, increase the proportion of AUM that will be managed in line with net zero. And this is the kind of increase in targets every 5 years is really in line with the Paris Agreement ratcheting mechanism, where countries are also required to increase ambition every 5 years. And there are also some elements of the commitment statement that apply not just to the proportion of AUM that asset managers are kind of going to manage in line with net zero, but across all AUM. And so this includes, as I mentioned before, working with clients to achieve net zero, so offering information, analytics, and products that allow clients to meet their own net zero goals. Creating investment products in line with net zero, as I mentioned, operating a net zero stewardship and engagement strategy. And this IGC recommends should involve a kind of relevant escalation and voting policy. And of course, engaging with other stakeholders across the industry, such as proxy advisors, data providers, credit rating agencies, etc. There's also an additional expectation that asset managers have a science-based policy on investment in coal and other fossil fuels. It wasn't a part of the 10-point commitment statement when it was developed, but it is recommended, and guidance is available from the investor networks on that. And we are increasingly seeing asset managers disclose their fossil fuel policies. So that's some of the key things in the 10-point commitment statement. It's available. I can share it, or ask Aurelia to share afterwards, and it's also available on our website. And asset managers should be kind of very aware of what's the kind of specific elements of the commitment statement before signing up. So that is a very specific set of commitment statements. It is designed to meet the kind of race to zero criteria and ensure emissions reductions in the real economy. So I think the next thing that's quite key is, the methodologies that are available to asset managers to develop a strategy that is consistent with this commitment. So to ensure that targets and kind of net zero strategies are robust and science-based, asset managers can choose from one of the recommended methodologies by the initiative, or a kind of combination of methodologies. So the first one being the Net Zero Investment Framework, which is developed by IGCC and the other regional investor networks. Net Zero Investment Framework covers target setting, but also kind of the actions and levers that investors have to increase alignment of assets, so around corporate engagement and policy advocacy, also kind of industry engagement. The other methodologies are the UN Asset Owner Alliance Target Setting Protocol, which covers target setting, and the Science-Based Target Initiative for Financial Institutions, which actually has 3 different types of targets that asset managers can set. And asset managers are allowed to use an alternative methodology, but they would have to explain the rationale for doing so in their kind of annual disclosure and reporting, and also explain how their kind of alternative methodology is really in line with the best available science on achieving net zero and the 1.5 degree goal of the Paris Agreement. So there are disclosure requirements also that all asset managers considering the initiative should be aware of. So 12 months after kind of formally joining the initiative, asset managers are required to disclose the proportion of AUM that will be managed in line with net zero, the 2030 interim target that will be applied to this proportion of AUM, as well as the methodology used to set targets. And we have a kind of online web form that allows asset managers to input this information, and it will be based on the methodology. The required information will be based on the methodology that asset managers choose to use. There are also some reasons why an asset manager may be delisted from the initiative, and that's really around kind of not meeting the initial disclosure requirements that I just mentioned, as well as not providing annual reporting. At the moment, we're not conducting, I guess, a kind of qualitative assessment. We're very much in the process of encouraging and working together collaboratively with asset managers to help develop that kind of knowledge and experience around net zero strategies and really playing that supportive role. But there are cases where we may need to delist asset managers from the initiative if they're not meeting those kind of essential disclosure requirements. We also may choose not to accept an applicant based on either the expectation that the asset manager has no intention to meet the disclosure requirements and requirements of the commitment, or is not able to kind of fulfill those requirements. As I mentioned, kind of we're in the process of really supporting asset managers, recognizing that it's the first time for most asset managers to make a commitment like this and deliver on those, but we will in the future consider whether further kind of assurance of targets and strategies is required. And the way that asset managers are required to kind of disclose annually is through PRI or CDP. I'm sure many of you are already kind of reporting to PRI, and from 2023 the PRI platform will be back up and running, but this year for managers it's only CDP because PRI is not running.
Daniel, maybe just in the interest of time, can I ask you maybe to conclude or in 2 minutes so that we can ensure the program goes smoothly, and we can, of course, continue the conversation bilaterally with you and with the members if they need more information. I think there's quite a lot to say.
Sure, I will I just wanted to note some of the disclosures that were made last year by net zero asset managers. So we had around 43 asset managers provide disclosures before COP26, most of whom, or over half, are using net zero the net zero investment framework. Others are using a combination of methodologies, and some also using SBTI. We also had so of those 43 asset managers that made disclosures, we had nearly 12 trillion in total AUM, and on average around 35% of an asset manager's AUM was committed to be managed in line with net zero. So if this kind of rate of ambition increases this year, and we're expecting disclosures this month, by 2022 we could have 20 trillion in AUM committed to be managed in line with net zero. And I will I will skip the element on joining and participation. We have an information session on the 20th of April that's open to asset managers interested in joining the initiative. So if you'd like to know further information or the opportunity to ask questions, feel free to register for that. I'll pass back to you, Aurelia.
Great, thank you, Daniel, and we'll also send you the presentations and the link to that to the information session that Daniel mentioned. And thank you for this great presentation. I'll pass on to Caroline Verle from the State Secretariat for International Finance in Switzerland, and focused on the Task Force for Sustainable Finance for a Swiss perspective in regards to net zero.
Thank you very much, Aurelia. It's a great pleasure to have a chance to give a bit of the background of our current thinking about financial institution commitments to net zero. As you know, I'm part of a newly created task force on international on sustainable finance that was created as part of the State Secretariat on International Finance, showing that we are really truly committed to positioning also the financial center in a good way internationally. So our work with the financial sector is really essentially in recognition that the financial sector has an important role to play in aligning its financial flows with the Paris Agreement. You all might know Article 1.2c. The key role of the financial sector in supporting the transition has also been highlighted, especially by the G20 this year. So there's work ongoing at the Sustainable Finance Working Group on, private sector commitments are being looked at very carefully. And the focus is especially on making sure that these commitments are credible. The urgency of this task is becoming increasingly clear, as highlighted by the latest IPCC report, that stresses the need to act now. We can also see that many financial institutions have now formulated net zero commitments, and I think Daniel's presentation has really showed this tremendous growth. And I would say that by now such commitments have even become the mainstream, with most of the larger financial institutions having such a goal. So the question has now moved on to making sure that these longer term commitments are translated into credible, concrete, science-based interim targets that are also made transparent. And this is the stage where most financial institutions are now, and the credibility and ambition of such targets should ideally be verified by a third party. And I think Danielle listed a few good methodologies in this regard. The progress made on the targets will then have to be monitored over time so that regular reporting on the commitments and progress will gain in importance. Today, there are already ways to assess progress, for instance, through voluntary PACTA tests, where you can get a clearer picture of the remaining exposures of certain portfolios on with respect to oil and gas, for instance. And Switzerland will carry out another voluntary exercise of this kind this year. So the expectations of the public on the required level of ambition by financial institutions is only going to increase over time, not only as better data and methodologies become available, for instance, for scope 3 emissions, but it's likely to go beyond pure emissions reduction or exclusions of high emitting sectors. So Daniel has already mentioned the important role that engagement strategies should play. But then there will also be the increasing notion of impact, for instance, with the need to increase financing of innovative technologies. Biodiversity will also gain importance, and looking at nature-related impacts and dependencies. You might have seen that the TNFD, so the Task Force on Nature-Based Financial Disclosures, has recently released a beta version of disclosures for public consultation. So you all are welcome also to look at this and provide feedback. Then the use of offsets will become more and more under scrutiny, and have the feeling that the standards there will increase, especially with, for example, SBTI's first draft guidance on to financial institutions, where we can clearly see that at one point, at least to claim a net zero status, you will only be allowed to use higher quality carbon removal offsets rather than only avoidance offsets. So we can clearly see that this is a very dynamic area that is likely to evolve, and financial institutions will need to ratchet up not only their commitments, but also the progress they make on reaching these commitments. And as the State Secretariat for International Finance, we want to support the efforts made by all of you. We are fully aware that this is, we are still in the early stages, and that many institutions are ready actually to be ambitious in the field. So we see a need to get not only as many financial sector institutions on board and committed as possible, but also more important, it will be important to ensure that these commitments are credible and that the implementation is also coming, especially as the civil society remains concerned that many of the commitments could potentially be represent greenwashing. So highly credible commitments, I think, would be a great opportunity also for the financial center to further strengthen its competitiveness and its effective contribution to sustainability, while also keeping a preference for a market-based approach that very much relies on voluntary commitments and no strong regulation. We see it as really an opportunity for the financial center also to support the transition and also the compatibility with biodiversity. And we're just hoping that the financial sector will be very proactive in a sort of race to the top to become leaders actually in sustainable finance. So the Federal Council has also mandated us to make sure that we get more transparency by financial institutions. That was already back in 2019. And more recently as well, so as recently as November last year, the Federal Council has also recommended the financial industry to join international net zero alliances, such as these GFANS alliances and the Net Zero Asset Managers Initiative in particular, and to seek industry agreements to this effect. So work on this is ongoing. And the current thinking is really to focus on the transparency aspect there, maybe in order to maybe aggregate all the industry's commitments in one place, so that it makes it easier as well for people who want to kind of gauge the level of ambition of various financial institutions. And we also very much welcome the efforts of AMAS. I must say, this is a great leadership effort to become a supporting institution of GFANS and really to organize these types of events, also to get a greater share of asset managers on board. I think this is a great way forward. I think I'll stop here, also for the sake of time.
Great, thank you very much, Caroline, for the overview of where the Federal Council and the CIF is actually looking at net zero initiatives. I think after this informative part, and mostly descriptive part, it would be interesting to understand more practically how did asset manager went about committing and implementing net zero for those leading asset managers who already committed. And so we'll have 3 case studies. The first one with Mirabeau. I'll give the mic, I pass on the mic to Hamid Amoura, responsible for responsible finance, head of responsible finance at Mirabeau.
Thank you, Aurelia. But I will take just the opportunity again to thank you for this invitation. And it's with great pleasure that I'm participating on this webinar on this very important topic. We are all aware that there is an urgent need to accelerate the transition towards global net zero emissions, and that investors and asset managers play an essential part in helping to deliver the goals of the Paris Agreement and ensure a just transition. And as part of our commitment, Mirabeau Asset Management have joined the Net Zero Asset Managers Initiative, as we believe that collaboration and joining efforts is important in achieving the net zero transition. It will be an excellent opportunity to exchange experiences and ideas with other members and leverage on experts' opinions to overcome some of the challenges facing the alignment of our portfolios. It's a natural step to join this initiative after having joined other initiatives mentioned by Daniel previously in the past, PRI, Climate Action 100+, CDP, TPI, each of which in its own way contributes to the same objective, to create the conditions for a better world by contributing to the improvement of good practices. Again, by joining this initiative, we ambition to explore ways to apply the available frameworks, tools, and methods to setting up our net zero targets and strengthen our climate policy. Maybe let's move on the next slide and see how net zero is currently implemented at Mirabaud Asset Management. Regarding our climate policy and net zero approach, we adopt a climate transition approach. Indeed, instead of divesting from fossil fuels and investing only in aligned issuers and low carbon emitters, we invest in companies on track to meet the Paris Agreement and thus showing the willingness to align. We view exclusion and divestment as an option only when engagement doesn't make sense or is unsuccessful. For example, we exclude investment in thermal coal companies, mining, as we believe that companies should exit coal and shift away towards renewable and sustainable sources of energy. In practice, as you can see on this slide, we identify the company's pathway by leveraging internal research, data providers. For instance, we use data from Trucast, as well as recognized industry initiatives such as SBTI, CDP, and TPI, Transition Pathway Initiative. We favor investment in aligned companies, climate solution, as well as companies on track to be aligned. We also identify high emitters that we believe are key in achieving the transition to a net zero economy. Engagement with this type of players is the pivotal building block of our net zero approach. But before going more detail on the engagement process, you will find on this slide the way we proceed to categorize each company via a scorecard system. Briefly, the idea is to identify and evaluate a company under three criteria. First one, the availability and quality of forward-looking data, which are the basis of the evaluation. The second one, it concerns the historical data. It's always interesting to assess the extent to which the trend in emissions up to now has been the right direction. And finally, has the company experienced significant emission reduction since 2012, for example? And finally, we also have a third section on climate change awareness and accountability. This involves assessing the extent to which the climate change issue is taken into account in remuneration policy with the development of dedicated KPIs on this topic. In this case, Ørsted, which is often used as an example of good practices in this area, is a fairly consensual case. As I said previously, engagement with these types of players is the pivotal building block of our net zero approach. Whether through individual or collaborative engagement, we maintain and aim to maintain a continuous dialogue by building a robust engagement framework centered around 1.52 degree pathway by 2030 and net zero by 2050. We challenge issuers' climate policies, targets, and governance of climate issues. Our approach is based on three steps. First, basically, we establish an initial meeting with the company in order to set out our expectations. Then we organize some follow-up to encourage the company to develop a response to the expectations. Afterwards, we review the response and evaluate if the company is progressing sufficiently. So far, we've decided to focus our engagement priorities on the more energy-intensive sectors, such as utilities, energy, basic materials, transportation, but obviously we plan to extend this coverage to other sectors such as healthcare, telecom, etc. And maybe before giving the floor to the other panelists, would like to come back maybe on the to highlight the main challenges we have to face. I see that the time is running out. I will only address for maybe the point 1 and 3. Maybe the first challenge. So, as you know, my team regularly conducts dedicated internal research and analysis on companies' ESG performance, which is supported by available corporate disclosures and data obtained through our service providers. The availability of data from publicly available companies' reports is not always comprehensive, which can limit the scope of our ESG assessment. So, in order to address the challenge of data availability, we regularly engage with our investee companies, both through fund-level dialogue meetings and collaborative initiatives, to access material extra-financial information that can guide our investment choices and analysis of key ESG risks and opportunities. So again, the scope 3 is also another important part, but as you know, for now, the scope 3, we can consider that the evaluation is really approximative, but maybe let me focus a little bit more on the third challenge. As steward of our clients' assets, we always act in the best interest and meet their demands. A key point raised by our clients is how we balance ESG results with financial performance and returns. So in order to ensure that there are no risks, impact, and performance, we are significantly strengthening our assessment of climate metrics through our climate policy, which falls under 3 main pillars: portfolio carbon footprint measurement, forward-looking transition and physical risk, climate risk, and the strong engagement framework. We believe that this climate policy will highlight those companies which are deploying strong climate change management frameworks, which will be best positioned to meet new challenges and requirements that are being put in place by regulators and industry bodies to meet the demands of the sustainable economic transition. So to conclude, I would say that Mirabaud Asset Management ambitions to drive change at an industry and economy level. That's why we choose this climate transition approach, and we'll be working to set targets that are in line with our vision and which embrace our willingness to be an actor of change and support financing the transition to a net zero future. Thank you.
Thank you very much, Hamid. And I'll pass on the mic to Jaffra Sarrazin, represented here by both Sacha Cesar and Benjamin Grenischer. Yeah, looking forward to hear Jaffra Sarrazin's view on the topic and how you implemented it on your side.
Thank you very much for having us. It's a pleasure to be here. So in interest of time, I'll move a bit quicker. So who's presenting for you today? My name is Sacha Cesar. I'm the bank's Chief Officer and Sustainability Manager and leading the bank's net zero efforts. I'm joined by my colleague, Benjamin Grenischer, who's a Sustainable Investment Analyst, who's leading the net zero efforts of our sustainable investment strategies. So to briefly highlight our own ambitions towards net zero and sustainability, our sustainability journey started over 30 years ago when we started kind of the first sustainable mandates in '89. We were founding signatory of the Principles of Responsible Investing in 2006, founding signatory of Principles of Responsible Banking in 2019, and in 2020 issued our own climate pledge aiming at net zero by 2035. We're also among actually the first Swiss financial institution to sign the Finance for Biodiversity pledge. And of course, last year in 2021, we joined the Net Zero Asset Manager initiative. And to highlight here briefly what Daniel already mentioned last year during COP or slightly before COP, the inaugural reporting was published by NZIM. We were among the 43 asset managers who actually participated in this reporting. And to briefly highlight, our commitment is that we have a sort of initial net zero commitments of 100% of our assets under management of our bank sustainable asset management. And but we not only have a commitment, but we're also already working on the implementation, and we have implemented our climate pledge already for 19% of our assets under management. And to highlight our methodology and the implementation of our climate pledge, I hand over to my colleague Benjamin.
Thank you. Also, a warm welcome from my side. I think we had a good setup from the start because even before Bank J. Sarrazin became a member of the Net Zero Asset Manager Initiative, we already had announced the climate pledge that you can see on the slide. To become climate neutral by 2035 is the big goal. Even though the exact implementation at that point had to be worked out, it was an ambitious goal, and I think it provided really a polar star that we can work to. This aim is supported along multiple avenues. One side, it's the investment process. We have an exclusion policy. We do a lot of engagement, and we are monitoring and measuring our own efforts. Today, I will focus a bit more exclusively on the investment process, because I think that's really at the heart of our efforts. So on slide 6, you will see how the target setting mechanism works and also the tracking. When we started to develop it, there has been very little guidance. So we oriented ourselves what was published in the EU as the regulation on climate transaction and Paris-aligned benchmarks. And I think it was only natural at that point to adopt a very similar approach. What we really do, and I really try to focus on the practical part, we calculate the footprint of the carbon footprint of each company. And with that, we can calculate the footprint of the benchmark of each strategy. From there, we reduce it as a starting point by 30%. The starting point is the 31st of December in 2020. And afterwards, the target is reduced yearly by 7% from the previous year value until 2030. From there follows a linear reduction until 2035. With this, we fulfill the requirement of the interim target of at least 50% reduction by 2030 in our portfolios, and net zero by 2050. We use the PCAF methodology on carbon accounting, and currently we do not use any offsets or carbon removal. What we have found is there's ample room within portfolio management, even keeping up the returns to reduce the footprint currently. We are obviously still in discussion because decarbonizing of our goal is a bit more ambitious than the wide economy targets. How we'll handle this discrepancy in the future. On slide 7, we have summarized a bit the implementation process. First, we have to set a target for each of our strategy, be that an investment fund, a portfolio, a mandate with a client, etc. And usually we follow the approach that I have just stated before. There were a few let's say key challenges. For example, when the strategy had no benchmark, we needed a workaround in terms of how do we set this initial target from where we decarbonize. Usually we use the portfolio as a starting point if we don't have a benchmark. Sometimes the strategy has been launched after the 31st of December 2020, so we have to adjust the base year and the decarbonization in that case to keep in line with our target. Another big thing is the treatment of different asset classes. If you have a very specific measure of the carbon footprint, that is measured differently for corporates or governments. So we have, for the moment, and that is also one of the key challenges, why it is 20% of the assets, we have left out the government part at the moment, and we are currently working on a methodology to address the government part of this of the asset classes. Next step is really to set up internal controls. So we have to update our internal investment strategy restrictions. We have to form the risk and performance committee that is in charge of controlling these restrictions. And we have to educate each portfolio manager how to use the tools available to him. So he has a footprint of each company on his Bloomberg. He can look it up on his portfolio in the Bloomberg. That's internal development. So we can really provide that as a service, and the portfolio manager has the possibility to do pre and post trade checks on his portfolios and really monitor where his carbon footprint stands. Then there's obviously the monthly control of where the footprint stands of each investment strategy. And we follow basically a comply or explain approach. If it deviates from the target of the portfolio, there needs to be an explanation by the portfolio manager provided. And last but not least, we also have the reporting of the investor. That's the previous slide you've seen there, where we show the development of the footprint over time. And that is available for all institutional clients on a monthly basis. And I think with that, I also want to conclude more or less. We have summarized that also and in our sustainable investment policy and our climate pledge on how we approach this in detail. And we have written several client publications on how to approach it, or how we approach this big challenge that we have all together. So thank you for having me. And I'll pass back to Aurelia.
Thank you very much, Benjamin and Sasha. Very interesting presentation as well. And I'll pass on to Ruben Feldman from ZKB for the final case studies. We're running a bit out of time, but I hope you can stay a bit longer for the next 10 to 15 minutes of this webinar. Thank you. Over to you, Ruben.
Yep.
And I think Marco will share.
Perfect, thank you. So thanks very much to AMAS and to all the participants for your time. I will try to be quick because we're out of time, but as Aurelia said, it will probably run over a little bit. ZKB is the third largest bank in Switzerland, which also comprises of a large asset management that manages about 220 billion. The focus is mostly domestic in Switzerland, but we of course have also an international reach in terms of our investments. And so actually what we did is join as part of the asset management and not the bank itself. And so we're a little bit peculiar in terms of it's not an entire legal entity that has joined, but rather the asset management operation. So if we go to the next slide. In 2020, Swiss Canto, the asset management of ZKB, announced that nearly all of their active products will be aligned to the Paris Agreement. So actually we have had a net zero target by 2050 already since then. And this came as a result of the 2018 IPCC report, where we have decided that it is our fiduciary duty, both as part of our societal responsibility, but also in terms of protecting our portfolios from upcoming climate risk. And this has been implemented since 2020. And of course, at that time, everything was quite new, including the Net Zero Asset Management Initiative. And so we kind of developed our own strategy in parallel to all the initiatives that were developed. And in 2021, we joined the Net Zero Asset Manager Initiative, which of course has a 1.5 degree target. So between 2018 and 2021, there has been kind of a shift by IPCC as well to focus on 1.5, saying that 2 degrees is just not enough. And the Net Zero Asset Manager initiative was for us an opportunity to gradually transition from this 2-degree trajectory on most of our funds to 1.5 degree, which is more sustainable. If I go to the next slide. So in our strategy, I think there's a slide skip there. We have a lot of different metrics that are used to make sure that our climate strategy and climate goals are achieved. Notably, of course, we use ESG integration, which incorporates a lot of environmental factors such as companies' environmental strategies, their transparency and other KPIs, which is key both in terms of removing laggards, but also improving our ESG integration, the score versus the benchmark. But here, in the interest of time, I'm just going to focus really on the more constrained part, which really makes sure that every year we will achieve a specific target, and by 2050 we'll achieve carbon neutrality. And the idea here is that from 2020 to 2050, we took the IPCC carbon budget for a 2-degree target of just over 1,000 megatons. And we took the integral of that, and we calculated that if you have a 4% reduction per year, every year until 2050, you achieve net carbon neutrality by 2050 without an increase of more than 2 degrees. For 1.5 degree, it's 7.5%. And so we're now having all of our funds are already constrained on a 4% reduction, which is a 2-degree pathway. And we're allocating more and more of our funds towards the 7.5% reduction, which will make them 1.5 degree compliant. So what does this mean? Well, to do it practically, what we use is carbon intensity, which removes a lot of the double counting issues. We use, for companies, we use sales as the divider, so tons of carbon over sales for government. So we also apply this on sovereign. We use total emissions according to the EDGAR database, so how much emissions have been emitted in a certain country divided by nominal GDP. The reason we incorporate here GDP is because, of course, if the economy grows and carbon intensity stays the same, you actually have a decreasing intensity. So you need to compensate for economic growth. And this essentially means that reducing 4% per year means by 2050 we'll have reduced by 70%, but actually the carbon intensity would have been reduced by 93%. And what's important to understand here as well is that as companies grow, the economy will grow, which means that they will have to produce more with even less carbon. And so obviously the efficiency will have to increase exponentially. If we go to the next slide. So the two tools that we use, apart from ESG integration and exclusion of certain investment business segments such as coal, is voting and engagement. So we have on all of our assets, including passive, where there is no necessarily climate strategy applied, we have voting engagement, which looks at implementing science-based targets for investee companies, and also tries to have KPIs installed for management with respect to environmental targets. We also use capital allocation, so we do partial or full divestment of companies to make sure that our portfolios in the end reach the climate target that we set forward. And so already we have interim targets from the get-go, because we know every year what our maximum carbon intensity will be towards the 2050 target. If we skip to the next slide. In terms of hurdles, so there have been some challenges that are resolved, some of them that are in the process of being resolved, and some of them that are in the pipeline. So one of the main things that we found very important was to have top-down commitments. So it supported the top management, both on the bank side and the asset management side, and also a system to track and measure these targets. So the system is quite complex and requires a lot of flexibility. So we have our own trading system and portfolio management system, which enables us to do this. We were also a part of UNPRI and other associations like CDP, Climate Action 100+, and so on, which helps with requirements of reporting, which we're in the process of implementing, such as TCFD. In terms of challenges, some of them have already been said, but I'll echo them. In terms of scope 3 data, we currently only use scope 1 and 2 because scope 3, the data is very sparse quality and availability. We have a problem with the way that the NZAM initiative the requirements are stated as they are right now, because we have a large allocation to passive mandates, where technically we don't control what the investment does, because the asset owner tells us to track a certain benchmark with a specific tracking error. So hopefully with their work with the asset owner initiative, that also helps trickle down to better decision making on our end when it comes to implementation for the asset owner. And then, of course, if the economy does not reduce its carbon efficiency, improve its carbon efficiency, which of course we try to improve with our voting engagement, it may mean that our climate target actually means that our portfolios become hugely different from the economy. And that might become problematic because it might be difficult to focus on generating economic return while taking on huge tracking error just for the sake of a climate strategy. So I hope that in the given time, I didn't skip too much of what I intended to say, but thank you very much. And I leave it to Aurelia.
Thank you very much, Ruben. And apologies that we had to go a bit over time, but we still have the majority of the attendees that stayed online, so meaning that it was a good program. So I wanted to thank everybody and all the speakers for sharing their experience and best practices during this first webinar on net zero. Thanks again for participating and sharing those insights. Of course, and I mean, this is a large topic, and I'm sure there might be a lot of questions. We won't have time for a question, unfortunately, today, but what I can suggest is that, of course, we will gather the question on the AMAS side, and if there is, and you can also reach out directly to the participants for specific questions, but we'll make sure to take those questions via email or bilaterally. The presentations and the recording of the webinar will be available on our website after the webinar. And with that, I want to thank you again and say goodbye. Thanks again.